Taxes. Possibly the number one thing that people dread paying the most. You work so hard every single day just to get 20, 30, 40, or even 50% of your entire earnings taken away in the form of taxes. I've spent about 7 years in the wealth management industry as a former wealth advisor, and I've worked with clients up to $100 million in net worth. So I've had hands-on experience working with these people and legally reduce the amount of money they're paying for taxes. And here are some of the things that I learned that can be applicable to pretty much anyone in America. Remember, I'm not a financial advisor, I'm not a CPA or accountant or attorney, so before you jump headfirst into these strategies, some of these strategies might not be right for you. Everyone's situation is different. Make sure you consult with a financial professional first. First, the primary residence capital gain exclusion. Let's say you live in a very popular place. Let's say you bought a house in that location maybe a few years ago and you've lived in that house, so it's your primary residence. And let's say the value of the houses have increased quite a bit since you bought the house. And now let's say, about 5 years later, you're thinking about selling that house. This is where this particular tax code comes into play. In other words, you can actually forego or not pay taxes on the $300,000 gain. According to IRS topic number 701, as long as that particular house is considered your primary residence, it's not an investment property, you've actually lived there for the past 2 out of the last 5 years, and you own that particular property, if you actually do end up selling your house at a profit, then you can exclude a part of that particular gain or profit. You can avoid paying taxes on the first $250,000 if you are a single taxpayer, and if you're married filing jointly, then you can actually avoid paying up to $500,000 of that gain. So here's a quick example. Let's say you're married filing jointly, you bought this house at, let's say, $300,000 in a prime location 5 years ago. You've lived in the house for all these 5 years, and now let's say, you or your spouse had a request to move location for your job, so you're relocating. If your house increased in value by $300,000, so now it's worth $600,000 after these 5 years, you can sell your house and not pay a single penny on any of those $300,000 in gains. That saves you thousands of dollars on taxes. Strategy number 2, SCorps. SCorps is essentially a tax filing strategy. For example, let's say you own a company and that company is titled as an LLC. You can actually elect to have your LLC taxed as an S corporation. Specifically, S corps, they save you on self-employment taxes. In America, those self-employment taxes, they encompass generally Medicare taxes as well as Social Security taxes. For almost every dollar that you make, S-Corps could help you save up to 15.3% in taxes, and it's all legal, and here's how you can do it too. If you have a business that is taxed as an S-Corp, then my friend, you don't actually have to take 100% of the business profit. And here's why that's actually a good thing. Self-employment taxes, which include this Medicare and Social Security tax, they're essentially levied on salary, right? So essentially what you're getting in a 9-to-5 job. In an S-Corp, you don't necessarily have to take a salary that's equal to the full profit of the business. The only key here is that in S-Corps, you do have to take a reasonable salary. So what that means is, let's say you have a successful agency that you copyright. Let's say, you write books or you ghostwrite for other celebrities or influencers. Let's say you make $200,000 a year. Maybe the average salary of a writer is, let's call it $50,000. Well, my friend, in an S-Corp, to save money on taxes, you just need to get that reasonable salary of $50,000. So you are paying self-employment taxes on the $50,000, but anything above that, if you decide to take that profit out of the business for yourself, can be considered a distribution. Business owners get distributions, and oftentimes distributions do not have to pay taxes on Social Security or Medicare, right? So in other words, you save self-employment taxes on distributions. The third strategy to pay less in taxes is leveraging deductions. You can claim many different deductions, especially if you're a business owner. Let's get into some of the deductions that business owners use today, leverage, and use to pay less in tax. Some of these deductions include travel, supply, advertising, home office costs, internet and phone bills, health insurance premiums, and even education or certification costs. In fact, according to IRS Section 179, business owners can actually write off, in other words, deduct, the full value of their vehicle used for business purposes in the first year. In other words, you can deduct the whole cost of the vehicle in the very first year of its use. The key here is, of course, that vehicle must be used for business purposes. The IRS, if they do end up auditing you and they see that, your car is used maybe 20% of the time for your business and 80% of the time for personal use, chances are you're probably going to be fine. Strategy number 4, HSAs. HSAs are also known as health savings accounts. And honestly, those are my favorite types of tax deductions. HSAs are the only triple tax benefit vehicle out there. And here's what I mean by that. HSAs, when you put money into health savings accounts, you get a tax deduction right up front. When you invest your money in HSAs, you actually get tax deferred growth. In other words, you don't have to pay taxes on the year of the gain, right? Or on any dividends that you earn. That's all deferred into the future. And number 3, the third tax deduction is when you take money out of an HSA, as long as it's used for qualified medical expenses, then you won't be taxed on that money either. So again, it's literally a triple tax benefit using HSAs. Here's the key. In order to get an HSA, in order to qualify for an HSA, you need to have a high deductible health plan. An HDHP is essentially a health insurance plan, but it has a much higher deductible than the average health insurance plan. Why would you want that? There are a couple of reasons. Number 1, if you're a pretty healthy person, you might want to go for that. Number 2, if you don't want to pay for expensive monthly premiums and you want to have your premium to be pretty much $0 or maybe $50 a month, then a high deductible health plan might be the right next step for you. And of course, if you're perhaps a little bit younger, 20s, 30s, 40s, something along that line, and you have a longer working career ahead of you, and you want to take advantage of an HSA, specifically the investment component, because again, to grow investments, you need time, then an HSA might be the right plan for you. Not every employer actually offers HSAs for their employees. You might want to check with your HR representative just to make sure that that is actually an option. And if not, you might ask if they are willing to instate one in their company policies. Let's jump into some of the qualified medical expenses that you could use and not pay a single penny of taxes for once you withdraw money from your HSA. Examples include ambulance costs, contact lenses costs, hearing aids, hospital services, nursing homes, and lab fees. So as long as you withdraw money from HSAs and use them for qualified medical expenses, then you won't be actually taxed on any of those withdrawals. Keep in mind, the list of qualified medical expenses is extremely long, so make sure that you actually take a look at it. The IRS offers a list, and I'm sure there are many other lists like that out there as well. Tip number 5, build a solo K. A solo K is essentially another word for a solo 401k. Most of you that are watching this video probably have heard of a 401k. 401k plan is specifically for employees, but what if you're an employer? What if you own your own business and perhaps you don't have any employees yet? Maybe it's just you, or maybe it's you and your spouse. Well, my friend, you should probably check out a solo K. Solo Ks are a really good way to stash away money, lower your taxable income, and essentially grow your assets tax deferred. This is one tool that the wealthy use and that I've literally helped many clients use and leverage to pay less in taxes over the long term and build long-term wealth. Now, the key to qualify for a solo K is that you have a business, number 1, and number 2, you don't have any employees in that business. The big difference between solo 401ks and a regular 401k plan designed for employees is flexibility. $22,500 if under 50, or 50 and over up to $30,000. Now, solo 401ks actually have the ability to contribute much more than that. And the real reason why is because 401ks have an employee and employer combined limit. And in 2023, that combined limit is $66,000. Since business owners are oftentimes also employees of their own business, the business owner / employee essentially can contribute up to the employee contribution maximum. So in this case, if the employee / business owner is under age 50, they can contribute $22,500 to a 401k plan. Now remember, my friend, since the 401k plan allows for up to $66,000 in combined contributions between employee and employer, then business can actually make more contributions to the 401k plan up to the $66,000 maximum. If you have a solo 401k, you can invest your money into index funds, mutual funds, ETFs, even crypto, real estate investment trusts, and so on and so forth. You can really tailor your investments based on your own preferences. Keep in mind, if you do end up opening a solo 401k, I would highly recommend you talk to an accountant, because accountants can really help you look at the minutia. There's so many moving parts that go into opening up a solo 401k, including plan documents, administration costs, etc., etc. So really make sure you look at that first before jumping headfirst into this particular type of plan. Here's another little secret. If you have a spouse and your spouse works in the business, right? So let's say you don't have any other employees, it's just you and your spouse, you can actually open up a solo 401k for your spouse as well. And not only do you have the ability to contribute up to a theoretical maximum of $66,000 in 1 year for yourself, but you could do the same thing for your spouse. In other words, you guys could be stashing away over $130,000 in 1 year and pay less on taxes in a given year. Tip number 6 is employing your kids. There is a way that you can take advantage of the tax code and actually employ your kids, give them money, not pay taxes on that money that you're giving them, and actually invest the money for them for long-term generational wealth building purposes. Having a conversation with your kid or children and making sure that they're up for employment. Assuming they are, then I would say let's go ahead and try to employ them in your business. They can be doing simple tasks like cleaning, administrative assistance, etc. But the point is, they're doing some sort of work in your particular business on a part-time basis. You can pay your child up to a maximum of $13,850 per year. Once you pay your child that money, you can actually deduct your child's salary from your taxable income, which of course means you pay less in taxes. And the reason why is because your child's income is essentially a business expense, and business expenses in general are tax deductible, which means that you pay less in taxes. Not only that, but when you hire your child and pay them that $13,850 a year, your child doesn't owe income taxes on that amount either. And here's the kicker, my friend. If you really want to take advantage of the tax code and try to build generational wealth, here's what I would recommend. Open up a Roth IRA for your child. Now, of course, since your child is under age 18, they can't do it themselves. So you would have to open up a custodial Roth IRA. Once the money is contributed, you can actually invest the money and let that grow year over year. So by the time your child is essentially age 30, it is probably light years ahead of the rest of the crowd. And that, my friend, is how the ultra wealthy really do leverage the tax code to build generational wealth for their kids and their grandkids and so on and so forth. Strategy number 7 is tax loss harvesting, also known as TLH. If you're an investor, then listen up, because tax loss harvesting can really cut your tax bill in half, if not more. Here's how you leverage the tax loss harvesting strategy. Specifically, you actually want to look for down years. So for example, in 2022, when the S&P 500 and other stocks were pretty much crushed, especially the tech sector, that would have probably been a fantastic year for you to take advantage of tax loss harvesting. harvesting. This is where you want to take a look at the stocks that are red or essentially indicate that you're losing money from where you originally invested your money, right? So let's say you invested in a stock that you bought for $100 and that stock is worth now $80. It's at a loss. You lost $20. If you decide to sell a stock at a loss, so let's say you sell that stock for $80 instead of $100 and you actually lock in that $20 loss, you can use the $20 to offset future gains, right? So let's say you sell a stock in the future with a $100 profit, you can actually offset the $20 loss with a $100 profit, and in reality, your profit would only be $80. And so you're paying taxes on $80 instead of the full $100 profit. That's one way to do it, to offset gains. Another way you can utilize losses is actually by offsetting ordinary income. And what I mean by that is your regular earned income in a given tax year. In fact, my friend, if you have a loss of up to $3,000, and let's say you don't have any gains that you actually made in a given year in the stock market, you can always use up to $3,000 of capital losses and offset that against your ordinary earned income. Now, let's say you sold your stock at a $10,000 loss in a given year and you did not make any gains in that year. You can still offset up to $3,000 of your ordinary income with these losses. So what happens to the other $7,000 of losses? Well, my friend, you can actually carry these losses forward indefinitely into perpetuity. So let's say the following year, again, you don't really make any gains in the stock market, you can take another $3,000 and set that off against your ordinary income, which again means you pay less in taxes. But beware of the wash sale rule. The key is you cannot sell a stock at a loss and then repurchase that very same stock in the next 30 days. Otherwise, the initial loss cannot actually be claimed for tax purposes. I would suggest waiting a little bit longer, giving yourself some more leeway. And also another key here as part of the wash sale rule is if you, let's say, don't purchase the same stock, but maybe there's another stock that is extremely similar to the one that you just sold at a loss, that could also possibly count toward the wash sale rule. So everyone wants to make passive money, right? That's typically the goal, to make money while you sleep. And one of those key strategies to make money while you sleep, especially that's employed by the ultra wealthy that I've worked with in the past, is investing in bonds. Now, bonds, they're kind of conservative. They act as a buffer to the stocks that you have in your portfolio, and bonds oftentimes also produce a passive income stream on a quarterly, semi-annual, annual, you name it, basis. However, my friend, oftentimes you do have to pay taxes on the passive income that is generated from the bonds. Here's how the wealthy get around it. They buy muni bonds, also known as municipal bonds. And generally speaking, the passive income earned from muni bonds is actually tax-free, at least on a federal level. What that means is if you live in a state that has high state income taxes like California or New York, for example, you might actually still have to pay state income taxes on muni bonds. Not always, but sometimes. But on a federal level, that passive income is generally exempt from taxes. And finally, tip number 9 is known as the Augusta Rule, also known as Section 280A. The Augusta Rule allows homeowners to rent out their house for up to 14 days per year and not pay taxes on any of the rental income generated during that time frame. The whole reason why we want to pay less in taxes is really so we have more money available to us, which essentially results in freedom. Actually, one of the best ways to improve your chances of becoming financially free is by earning more money. So make sure you click on this video right here where I'm gonna show you the exact steps that you need to take today in order to make more money and get closer to your goal of financial freedom.